Retail sales in Singapore fell 2.9% on year in December 2024 to $4.6 billion. This marks a steeper decline from the 0.5% drop in November. However, analysts say there is no cause for concern, citing more outbound travel among Singaporeans in December due to a stronger Sing dollar. Consumers might also have delayed spending to prepare for the Chinese New Year. Most retail sectors saw declines, with computer and telecommunications equipment, as well as mini-marts and convenience stores, among the hardest hit. In contrast, the food and beverage sector rose 1% to about $1 billion, even as growth slowed from the 4% gain in November. Food caterers led the way with a 16.7% increase in sales, while cafes, food courts and other eating places registered a 2.7% decline. Market watchers say rising global uncertainties, such as trade tensions, could dampen demand for goods and services this year.
We are a trading nation, both for goods and services. So it's clearly going to be a case of how severe worries about global growth and global demand will be in the coming months. And that clearly will depend on what's happening on, say, the trade war front and on perhaps even on geopolitical as well. For now, fingers crossed, still looks fairly resilient.
Stable returns can be expected from Singapore's largest commercial real estate investment trust. Despite issuing more units in the second half of 2024, CapitaLand Integrated Commercial Trust has kept its distribution per unit, or DPU, steady at 5.45 cents. This signals strong earnings growth as profit paid to investors per unit they own remains undiluted. For the full year, the Trust's DPU rose 1.2% to 10.8 cents, giving a 5.6% yield based on the $1.93 closing price on 31st of December last year. Distributable income also rose 6.4% to $385.7 million. The growth is attributed to the acquisition of a 50% stake in Ion Orchard and improved performances across its property portfolio. Chief Executive Officer Tony Tan cited strong tenant demand with a 96.7% occupancy rate and positive rent reversions in Singapore's retail and office sectors.
We potentially may be ready to look at a new AEI in 2025, one or two. Once we have some clarity on approval, what are the numbers that we're looking at, financial returns, and we have the capacity to do that. So we would likely will move ahead, given that we have that financial flexibility. But timing-wise, it's still under consideration.